Hi, welcome to Market in a Minute. So, Powell speaks at Jackson Hole on Friday, and this has always been a big event where policy can be reshaped. So, I kind of wonder if Powell is going to fumble the ball or he's going to deliver what the market needs. So, the internals of the market, they're really interesting right now. The internals they really need a rate cut because they ran the Mag 7 up so much. The market needs to rotate. It has started to rotate, but it needs clear visibility that we're going to see multiple rate cuts next year. So on Friday, that's a really important event, and we'll see how Powell handles it. So Powell will speak, on Friday, and I think he'll weigh both the inflation side and the employment numbers. The inflation side wasn't great. I mean, we had PPI, which was much higher than expected last week, and so the employment numbers were really disappointing, I have to say, kind of shockingly so. And so we'll have to see how they interpret those numbers. The market really needs Powell to cut rates and cut rates multiple times. But I want to look at M2. What's the fundamentals of the economy right now? And M2 is growing at roughly over the last 12 months, roughly 4.5%. So on average, over the last 25 years, M2 has grown roughly at 6.3%. So M2 growing at 4.5 kind of equates to nominal GDP growing also about 4.5. So if inflation's running 3, maybe 2.5 to 3, but call it 3, that means that the GDP is going to be growing at a roughly 1.5%. So that's a little disappointing. So that's Trump's point. He needs those lower rates, get the money supply growing, get the economy going. So it would be really interesting to see inflation down at 2 and nominal GDP at 6.3. That would be a great economy. So Powell has to weigh the pros and cons of cutting rates and giving that visibility or not. So we'll see if he can make the shift in his speech that he's going to start cutting rates over a more sustainable period and get them down to a more reasonable level, given the issues that are in the economy currently, and keeping it afloat. We discussed the Mag 7 or Mag 8, we like to say. So the 8 largest stocks in the S&P 500. We talked about that last week, that the 12-month forward earnings basically prices in, a lot of really positive news at this point. So we don't think that the Mag 8 can really do a whole lot from here in terms of outperforming the overall market to carry the market itself. So we really need a rotation. Now there are some companies that are just below that cap range, kind of second tier companies versus the Mag 7 themselves that still look very interesting. So technology may not be a sell at this point, but as there are some companies that could carry the load a little bit. But the market itself, it really needs to see those rate cuts coming through. The other part of the markets have started to anticipate rates coming down. Like the housing sector. Those housing stocks have come up quite a bit. Lowe's and Home Depot have performed well. We anticipated that pretty well when we got in those early, but those stocks need rate cuts, so nothing's changing. One cut in terms of rates is not going to do a whole lot to their businesses. So the markets are really dependent on the Fed cutting rates, probably more so than most Jackson Hole speeches. So Powell needs to deliver. And you look at the valuations, value doesn't matter until it matters, they say, right? So the value is high. So if Powell doesn't cut rates, these valuations are going to come in. And we're going to probably see that seasonal correction that we have been anticipating unless this occurs. Now, if you look at the PE multiples going out 12 months, the S&P is at roughly 22.9 times. So that's high. And granted, those Mag 7 stocks are accounting for a lot of that distortion in the valuation of the S&P 500. But the underlying stocks in the S&P 500 have moved up as well. So another way of looking at valuations is the price to book. So the price to book back in 2000 was at 5. Okay, that's a very high level, and now it's currently 5.4. So the price to book is now higher than what it was in the year 2000. We bring this chart up because it's been going around the last week or so. People are starting to look at the price to book and saying, "Wow, look at this." The PEs haven't gotten there yet. I mentioned 22.9 times the next 12 months earnings. In 2000, they were 24. So we're not far from that. Price to book higher. So there's different ways of looking at things, and clearly the market is at an expensive level and really needs the Fed to deliver. Now, one area that has not done well, out of favor, is healthcare. And we think the market's being very short-sighted, like it always is, right? It always goes to where the momentum in the market is. And we pointed this out several weeks ago, that the relative value of healthcare really has never been this low. It's right at that level, right at the historical lows in terms of relative valuations of that group versus the overall market. Now, what changed last week was, the filings, SEC filings by Buffett's Berkshire Hathaway Group show that Buffett bought a very large position in United Healthcare. So it's kind of an endorsement of their fundamentals. We would agree with that. We like United Healthcare, and it certainly got way oversold. Now, if you talk to any money manager around the country, you talk to them about healthcare, the number one issue is drug pricing, without question. And they don't want to go into it until the drug pricing issue is resolved. Okay, by that time, this group's going to be a lot higher. So anticipating that they will resolve it. So what's going on, like Lilly's a good example. They're going to start to sell their very popular weight loss drug directly. And so it takes out the middleman. And so if you take out the middleman, there's a lot more pricing flexibility that the drug companies can have. They still maintain their profitability, but they have more flexibility to bring those prices down to be more competitive with the prices they sell overseas. So this is getting resolved. When you look at the chart of the healthcare sector itself, as we pointed out, when it got down here, hey, it's down to the low again that it was in May. This is set up, you had the 20-day, the 50-day, the 100-day, all below the 200-day, kind of set up very nicely for a rally, and that's exactly what happened. So as you cross that 20-day, our technical indicator, not our fundamental, but our technical indicator said, okay, this is a buying opportunity. Across the 50-day, it continued across the 100-day. So we like to see that. Now the next area is the 200-day, and it's right at a resistance level. So you can see it made these prior highs like 4 times in a row and pulled back. We'll see if it can break through there. I think the market corrects. I think the healthcare sector picks up in terms of its relative valuation. I think it'll hold up pretty well. I want to talk a little bit about what's going on in the biotech space because everybody knows we're pretty active there. Starting with Journey Medical, DERM. The stock shot up last week right before they reported to above $8. They reported the stock corrected, about $1, right? So not a big deal in terms of the dollar movement. Percentage-wise, 10-15% is what it pulled back to be. I think this one goes a lot higher over time. So I'm not really interested in selling it. If you have a big position in Journey Medical, you might want to trim it a little bit as that's doubled over the past year or so. But we like that one a lot. DERM, we like it a lot. Their drug's going to be a really nice drug, and ultimately probably somebody's going to come in and buy them. Grail's around $32 a share. When we originally bought it, it was in the teens, the mid-teens, around that level. It shot up to 60. We trimmed it back, pulled back a lot. I think at $32, it's a nice valuation. They're moving along with their trial to get approved, but doesn't stop people from using it, right? So people are, actually the insurance companies are starting to reimburse on this thing already. But once they get the endorsement by the FDA, the approval by the FDA, it'll expand the market greatly. So we think that at 32 is reasonable. Below 30, it's a compelling buy, and they'll have their data sometime out in the first half of 2026. Anavex, okay. Now, some idiot put out a short report on Seeking Alpha. It's total BS that you got to sell it in front of the EMA approving it, the Europeans approving it, maybe in December or first part of next year. Okay, it's silly. Okay, if they don't get approved, the stock maybe goes to 5. They've got a big pipeline. They have their schizophrenia data coming out here soon. That's going to be a catalyst for the stock to move as well. But if it gets approved, it's going to go up tenfold. That's a tenfold move in that stock potentially on approval in Europe, and then they're going to file for a meeting with the FDA to see what they have to do or not to get approval by the FDA. So you're going to see that meeting sometime probably in October. So downside, there's about 50% downside. Upside, there's about 10x potential in a short period of time on this stock. So really stupid short report. Veru, okay. Oh, brother, this is the one we liked a lot. It's pulled back on the reverse split. I thought everybody knew the reverse split was coming. But, as you can see historically what happens on these reverse splits on a good company, it'll fall 20 to 30%. And that's what happened with Veru. So we're still optimistic about this company. The drug looks beautifully. There's been some mismanagement of the stock. I have to say that the management team could have done a better job with that. But we think this stock looks compelling here. They still need to get financing. Hopefully they'll do it on a non-dilutive basis by signing a licensing deal with Lilly or somebody else of that nature to fund the clinical trial they're going to have to do, the phase 3 clinical trial. But that company looks really, the drug looks really good. And then FBIO, as you know, FBIO owns half of Journey Medical. It's trading well below what that half is worth. I mean, well below. So there's a lot of value in Fortress Bio, FBIO. We think there's some data coming out here in September that's probably going to drive that stock higher. So looking at the healthcare sector, there's some good companies. We like Lilly, we like AstraZeneca. There's other drug companies that look interesting, but those are the growth companies there. And then the small cap biotechnology, there's a lot of really interesting stocks that we like. You can play the sector itself. I think the sector is very defensive and has good upside potential. So if you have any questions, please ping us. Come to my website, Patrick Adams, CFA. Sign up for a hard copy of Market in a Minute. We'll send that to you every week. Take care.